In this education series, I'll be discussing the Pakistan Stock Exchange, particularly its benchmark index, the KSE 100 index, and I'll also be shedding some light on the happenings in the global markets. Let's begin. The benchmark index slid by 282 points to close at around 38,000 points. That is a decline of 80 basis points on a day-on-day basis. Reason for the decline could be attributed to lack of clarity on the upcoming budget, which is due in the coming week. Why so? Investors aren't expecting businesses to do well in the current pandemic situation. That, coupled with the substantial increase in the COVID-19 cases, the most recent figure was exceeding 85,000 cases. Both of these coupled together have triggered profit taking. Profit taking has been witnessed in the following scripts and sectors. Oil and gas development, OGDC, declined by 2.1% day on day. PPL declined by 2%, followed by UBL, which also marked a decline of 2%. HUBCO and MCB marked a decline of 1.9 and 1.8% respectively. POL, Lucky Cement, and Anglo Corporation also marked declines. On a year-to-date basis, the 100 index has marked a decline of 16%. It's a substantial decrease. The market capitalization closed at around 6.5 trillion. This translates to approximately USD 40 billion. Change of around 82 basis points on a day-on-day basis, just in line with the benchmark index. Similarly, as the 100 index has marked a decline of 16% year to date, our market cap has also dwindled by around 17%, right parallel to the market. On a year to date basis, foreigners have recorded net outflows worth USD 260.9 million versus net inflows of USD 50.3 million in the corresponding period of the previous year. What this means is that foreign investors have taken out their cash from the stock market during the current calendar year by around 260 million US dollars. However, in the previous year, they had injected 50.3 million US dollars. While many of us may consider this to be bad news, many might argue that this is a good thing, because when your foreign investors pull out their money from the stock market, your domestic investors, they step up and they take up that empty space. They fill up that void. And your domestic investors are generally less risk averse compared to your foreign investors. So if there's a bad news in the market that may negatively impact the economy, generally speaking, your domestic investors, they don't exit their positions right away. They hold. They maintain a hold stance. So, based on the current scenario, it would be wise to remain cautious and sell on strength. You could do that, or if you are a risk taker, you could invest in piecemeal, buy in chunks, set your target prices. Once this particular stock you're interested in reaches that target prices, you can buy another chunk, or you could invest indirectly through mutual funds and thus reduce your risk. We'll be discussing systematic and unsystematic risk in the next series. Let's see what's happened in the international markets. So international markets have depicted a sharp decline from Feb till April. However, some recovery has been witnessed. The recovery has been observed in both the equities as well as bond markets. Let's have a look at the equities first. So the Philippine Stock Exchange Index has managed to grow by 4.3% on a day-on-day basis. Kuala Lumpur Composite Index up by 1.52. The Taiwan Stock Exchange up by 60 basis points, around 70 basis points, excuse me. The Korean Stock Price Index up by 20 basis points on a day-on-day basis. Shanghai, Bombay Stock Exchange, and Indonesian Jakarta Exchange have marked a day-on-day decline. The improvement has been supported by various factors, such as the increase in social movement in an attempt to get the economy to pick up pace, substantial support by the governments to local economies, temporary repayment of debt for the emerging market EM countries. So, due to lifting the social mobility restrictions coupled with the stimulus package provided by the governments to the local economies, the sharp sell off in the bond market has reversed its trend, which was taking place from mid Feb till mid April. Bond markets are also now portraying some normalcy in their trading activities and prices are turning favorable. So, this may be having a positive impact on the mark to markets. So, keeping all of this in mind, we can see some recovery in sight, but any surge in COVID 19 cases in the future may turn the tide in the opposite direction. So, my advice would be to stay cautious. If you want to invest, do it indirectly through mutual funds so you mitigate some of the risk. If you are less risk averse, then invest in piecemeal. And if you just want to exit, then make sure you sell on strength. In the next lecture, we'll be discussing systematic and unsystematic risk, equity betas, and we'll be applying those to the capital asset pricing model. So I'm going to try to publish this commentary on a daily basis just to keep everyone updated. It's good information to have, it's good knowledge. You can spread it, you can use this knowledge to make informed investment decisions. And also in the next series, I'll be discussing the systematic and unsystematic risk, and we'll be using that in our capital asset pricing model. So subscribe and hit the bell icon. Thank you for your time.